Welcome back, traders and investors. We have Bill Decker on the line. He is Chief Investment Officer of LocalShares Incorporated. Bill, how you doing today?
Doing well. Hope you're well too.
Yeah, we're doing good here on this Wednesday. Could you just give us your education and then your background in the markets?
Sure. I went undergrad at Baylor University in Waco, Texas, and then grad school for an MBA finance at Pepperdine, and worked for Morgan Stanley in Palo Alto, California for about 13 years, and then U.S. Trust Bank of America in Nashville, Tennessee for 5. So about 20 years working for the big banks or wirehouses, and then have run my own RIA for a little bit over 5 years here in Nashville.
Okay, so now you're associated with Local Shares Incorporated. Could you just give our listening audience a little bit of background on that company and what it does?
Sure. It's been interesting. I'm associated with it, by the way. I'm one of the founders, and then also my firm, my RIA, is a sub-advisor, so we manage the portfolio. And the idea behind, kind of why we started it, the idea was we know people like to invest in locally headquartered companies. I mean, you can actually see it statistically, whether that's because they happen to work there or their neighbors work there or they drive past the headquarters. More Coca-Cola is owned per capita in Atlanta than other cities, more 3M, Target in Minneapolis, St. Paul than other cities. And so there is a preference for that. And actually, in some places, Nashville being one of them, it makes pretty good sense. You can look. It's been a great pick list to pick investments from. So if people like to do it, and in some places it actually makes sense to do, what we thought is, okay, can we come up with a product that is intelligently designed and cost efficient, and maybe come up with a better way for people that want to invest locally, a smart and easy and cost efficient way for them to do that. And so that's how we set up Local Shares as a company 2 years ago, and then just over a year ago launched the first fund, NASH, ticker symbol NASH, which is the Local Shares Nashville Area ETF.
So I see it's kind of a new issue here. So do you have it just for Nashville, or do you have like a DET ticker for Detroit, or is this the only one you've launched so far?
At this point, the only one we have is Nashville. We've talked to some people in several other cities and have an idea of some cities we might go to, but we're focused right now on making the Nashville one work and getting it up and running, and then we'll look at maybe expanding. But we crossed the 1 year mark just at the end of July for the Nash Fund. So we've been working on it for about 3 years before that, so we've got about 4 years work into it, but 1 year of actually trading for the first fund, the Nashville Fund.
And so what are some of the Nashville companies that make up this ETF?
Well, to be included, kind of the inclusion set, we said you had to be headquartered in Davidson County, which is Nashville, or one of the 6 contiguous counties. You had to have market cap of 100 million and trade 50,000 shares a day on average. So that gives us 23 companies. As far as size, the biggest ones people would know about, HCA, Dollar General. Those are the two biggest companies, big positions we have. AmSurge, LifePoint Hospitals, those are our 2 biggest positions right now. But it's not, Nashville's known for healthcare, and the fund is about 33% healthcare, 34%. But we also have Genesco, makes Johnson Murphy Shoes, Brookdale Senior Living, Noranda Aluminum, Cracker Barrel, Kirkland's. We have a wide range of companies, so it's a nice diversified portfolio too. Tractor Supply is obviously one of the big companies. So we have 23 that meet that criteria for inclusion, and then the fund is always going to own at least some of those 23, and we rebalance quarterly based on our algorithm.
Okay, and so let's talk about this Dollar General here. It's been quite the wild ride. You had Carl getting involved, and then that fell through, and the stock really came back down to the area that it was at, and now it's kind of had a slow roll north. So, boy, when that stuff initially came out with Icon, and this thing got sprinted over $64, do you always have to keep a certain amount of of shares in there to keep it balanced, or was that just too much of a windfall? It actually went on June 9th and went to 65.99, made a new all-time high. Did you get a little bit of itchy out there with your finger on the sell button, or are you mandated to keep a certain portion in your ETF to keep it balanced?
Well, it was when we set up the quick answer is, yeah, we're mandated. We're going to own some of every stock that meets the criteria for inclusion. And it was important to us to set it up as a passive fund. One of the things we want it to be, as cost efficient as possible. So you're really not hiring Bill Decker and his gut feel on the companies as much as the model that we picked up. So, you got to decide how you want to do that. If you equal weight, you're going to own way more of some small companies than you probably ought to, maybe even have concentration problems. If you cap weight it, you don't really add that much value. In this case, you're going to own three big stocks here in Nashville and not much of the others. So we have a modified equal weight. Starts off with an assumption of equal weight, and then based on 7 different factors that what you want to call it, smart beta, that type of thing. But growth return momentum. Do they pay a dividend? Lack of volatility. So those several of those things out there. And so the movement in the price would affect what we own by the model, and we do rebalance quarterly because I think with 23 companies, you don't want to go a whole year without rebalancing. So the price move, as in Dollar General or any of the other components, that would factor in and would probably change what we'd own in it. But it's based on the model and the algorithm, not my gut feel.
Okay, that's always good. You might have touched on it there, but you talked about your algorithm, and I know you don't want to give away your secret sauce here, but can you just talk about, and maybe you already did, but just some of the components of your algorithm?
Sure. And actually, as a passive fund, and the index is managed for us by a company called Selective that does a lot of index calculation work. So people can go to the Selective site and actually download the 8-page white paper. So the secret sauce isn't so secret. You can go and read the algorithm directly. But the idea there was, how do you intelligently balance and rebalance this portfolio and but maintain diversification. So what we decided is you start off with the assumption of an equal weight. Make it easy. Let's say there are 25 components. So at the beginning of the calculation, everything would be 4%, and then it's going to move up or down. It's never going to be less than 1/4 of that. So it's never going to be less than 1% position, and never more than twice, no more than 8, because we really want that diversification. Our mandate is people that say, I want to invest in Middle Tennessee and Nashville-based companies. And so we want to own all the companies that fit in that criteria. But then, for example, on growth, we look at year-over-year growth of free cash flow. On liquidity, we take a look at the market cap and average daily volume, low volatility, straight a beta over the last year. Momentum, that's pretty easy to figure. We weighted about 2/3 3 months and 1/3 12 months. For return, we use ROIC, return on invested capital, similarly to our factor for growth, and even growth for valuation, where we look at EBITDA by enterprise value. The companies in the portfolio are different industries, so it's not all healthcare. You got to compare a manufacturing company to an aluminum company to a restaurant to a hospital management company. And so we think some of those factors give us a better job of comparing across industries. And what we've tried to do is these are factors that most people will agree are at least coincident with good stock performance. They don't always predict it, they don't always drive it, but it's a smart way of balancing the portfolio based on those things. And if you look historically, there's academic background and reason to think they're coincident with good stock performance and makes an intelligent way of rebalancing the portfolio. I wish it was a secret sauce, but it's not. I think it's smart, but it's not secret.
Okay, all right. Well, that I definitely get your point there. So besides this ETF that you created, you're an RIA. So obviously you have your clients in other investments. So are you a stock picker, or do you like to go to other ETFs for diversification for your clients?
We really do both. I think the ETF industry and the solutions that are out there in the ETF space are really attractive ways of getting exposure to areas that clients want to have exposure. So, you think of 20 years ago, you had to buy B share funds or pay eight, well, not quite, but big loads to buy into funds. And the ETF space has just provided a fantastic array of, once you've identified an area of exposure you want in a portfolio, it's easy cost efficient and fairly simple to get that exposure. So we do use a lot of ETFs. We also do individual stocks. From a strategy perspective or return expectation, I don't think it ought to be all that different. It's just, if it's a smaller portfolio, it's a whole lot easier to manage it with ETFs. If it gets to be a real large portfolio, owning some of the individual stocks seems like a good idea too.
Okay, all right. And do you carry any black swan protection for your clients? I know it's really been a losing proposition over here over the last 3 or 4 years, but do you keep any kind of puts or any kind of something in your back pocket here? So if you come in and the market's down 300-400 points, or is it just not cost effective to try and put on hedges in this kind of market?
Well, it's certainly not cheap. And we look at them all the time and read about different ways of doing it. I'm not saying we'd never do it, but typically we end up most of the time after looking at all those solutions coming back to the plain simple idea that just increasing your cash position is a pretty cheap way of providing some safety to the portfolio. So that's kind of our default, is just reducing exposure to the market if you're worried about the market is a pretty clean, efficient, and simple way of accomplishing what you're talking about.
Okay, all right, that makes perfect sense. Yeah, utilize the futures or options market at all?
In local shares, not at all. Not at all. We're just long only the equities. In our RAs for clients when we're running whole portfolios, we do use the options market, not so much the futures, but mostly in the area of writing covered calls on positions that we own.
Okay, and do you use a mix of fundamental or technical analysis, or do you turn to just lean towards the fundamentals?
No, we use both. I mean, I'd say, I start off from the fundamentals, but we've got a couple of sources on technical advice that we pay a lot of attention to at the end, for implementation. So I think you try to glean wisdom about this market wherever you can get it.
Okay, and I think we're at a really interesting juncture in the market. The S&P futures, what I like to follow very closely, had pulled back from 1985.75, hit 1890 and a quarter in the pre-market session last week, and we've rallied all the way halfway back here and just been flirting with that level. Do you think we have the gas just to keep going here back up to new all-time highs, or do you think we have some more work to do on the downside?
I wish I knew, and my first response is, I kind of both of those. But I wish I had the foresight and the omniscience to know what was going to happen. But I think both of those could happen. I think it makes sense always. You just got to decide how much exposure should you have, and then do you have smart exposure, and then you got to kind of live through some of the volatility. Most times we get paid pretty well for living through it.
Okay. All right. That sounds great. Great answer to that. Bill Decker, Chief Investment Officer of LocalShares Incorporated. Take a look at it, that ETF, NASH, NASH. I think the next one you should do should be DET, Detroit. Put Ford, General Motors, a couple of those other companies in there. So when you come up here to do your research, let us know, and you can stop by the world headquarters of Benzinga.
Sounds great. I appreciate the invite, and we'll look forward to making that happen. Thanks very much. Have a good day.
Okay.